Hey guys, today I want to talk about at which price you should buy Nvidia and if it is overvalued right now or not. I can tell you already that it's really overvalued, so you shouldn't buy it right now. But we will see by how much. We'll start with looking at the graph of Nvidia, and we'll see that it's at all-time highs, which makes me not want to buy the stock because I want to buy stocks which are at discount to the all-time high. That doesn't have to mean that a stock is bad if it is at all-time highs, but I like to buy them at a discount. What really tells us if the stock is overvalued are the numbers, the financials, so let's look at them. First, let's look at revenue. It's rising by a lot. Net income is there and is rising also. Then we want shares to be falling, which they surprisingly are because the stock is overvalued by a lot. Then we want to see a look at the cash flow. The cash flow from operating activities is rising also, and free cash flow is rising too, more or less. Okay, and then we want to look at total debt, which is 12 billion, and we want to look at net income, which is 4 billion. Okay, that's not too much debt. Now let's start calculating the price of Nvidia. We'll start with more reasonable calculations and then continue with more unreasonable calculations. Revenue of 26.9. Revenue growth of, let's say, 12% maybe. 12% would make our revenue go to 83 billion, which, yeah, let's take this as a starting point. Then profit margin, we'll just take the average. Net margin around 30 maybe. Let's start with 25 to go for lower assumptions. 25%. Price to earnings, we'll start with 15 with very low assumptions. This gives us a starting price for Nvidia of $36 per share, and it's currently at 468. So it's quite overvalued with these assumptions. Let's put in high assumptions. Price to earnings 20. Gives us a starting price of $48. Let's go with the highest price to earnings we'll give the stock is 25, because you shouldn't really go over 25. At least that's what I think, because everything above that isn't guaranteed you'll get your money back. Because you have to rely on people paying really high price to earnings ratios to get your money back. And in this case, 60 would be our entry point to buying the stock and making 15% profit every year, which would make our initial investment go to a 4 times investment in 10 years. Let's put in some higher numbers. The highest profit margin, which would be 45%, which is really high for a chip manufacturer. But we'll just put it in to look at it. 100 euros as a starting price, and even in this case we would lose money with these assumptions. If we bought at the current price, we would only make 0.8% of our initial investment, which you can see right here. But 45% is a bit too high. Let's put in 35%. And let's try to make our revenue growth go as high as we can to let's look at how much revenue we would have to make to buy it at the current price. So we'll go to 15%, which would make the revenue go to 108 billion from 30 billion. That's not high enough. 20%, not high enough. 25%, not that. 25%. with 25% and $250 billion in revenue in 10 years, you would have an entry point. You would almost make a 2 times investment, which is worse than any ETF. 30%, almost there. 35%. With 35%, let's go 32%. Around 32% would be your revenue growth per year, which would make 30 billion in revenue go to 430 billion in revenue, which is a lot. I think the revenue of Apple is, let's look it up. Apple's revenue is 390 billion, and it's the biggest company in the world right now, I think, with the highest market cap. So it would grow, it would have more revenue than the biggest company in the world right now to justify this price at a reasonable price to earnings. At 25 is still high for price to earnings ratios. But it could stay at 25. I don't think it will really go below that, but you don't know. It could. So you could, of course, take a higher PE, but no one guarantees you'll get your money back. So I wouldn't recommend doing that. You can just calculate it yourself if you want to really do such a risky investment. Now we'll look at the cash flow valuation model. We'll put in the stock ticker, Nvidia, and then we'll look at the growth rate. It is expected to grow 100% every year for the next 5 years, so we'll just trust that some bankers know that. I don't trust them really, but we'll just put them in. 50% because this model, and go half of the growth rate for the next 4 years 6 to 10. But even with these high assumptions, we'll probably not make our money back. Year 0 free cash flow is $3 billion, 3.8 billion. Let's put in 3,800. Stock-based compensation. You can look at that in Yahoo Finance. It's 2.7 billion. Which is a lot of the free cash flow. Cash and debt. We'll just look at net debt. In this case, net debt is, I think, they have more cash than debt. Yeah, it's 1.26. And shares outstanding is 2,500. In this case, it would surprisingly be at a good price, which I don't really trust right now. I'll look into it for a second. Yeah, now I know why I can't trust it. Look at the numbers. These are $260 billion of free cash flow, when it's only making 400 billion of revenue in the highest assumptions which you could make. So this we have to put some lower assumptions right here. We'll put 50% and 25%. That's more reasonable. In this case, our free cash flow would grow to 25 billion. That's even a high free cash flow if we would have 400 billion in revenue, and in this case it would be overvalued by 763%, which would make it, you would have to buy it at $54. And now let's put in some more reasonable assumptions like 25%, 12%, maybe a bit higher, 30%, 15%. Yeah, let's aim for 12,000 free cash flow, 45%, 17%, 40%, 20% maybe. Yeah, let's say that's reasonable. In this case, you would lose you would have a current margin of safety of minus 1,300%, and you would need to buy at $33 per share. So even this, every valuation model says you shouldn't buy Nvidia. You can trade it, of course, but don't invest in it right now. It's not worth the money you would have to pay, and you would have a high risk. Or if you want to really put in money, put in a really low amount of like 1% of your portfolio or even less. But I can assure you, you will probably not get your money back, or it will be a really risky investment. So you have to think if you want to lose your money, or if you agree with my assumptions. If you don't, you can always try calculating with other values. But when you take a low PE like I did with 25 price to earnings, you can't really justify investing in Nvidia. Which other stocks are there you could invest in? You can look at my channel. I've made a video about PayPal. You can invest in that. It's gone down a bit, but its financials are still really good. And you could probably make a bigger profit of PayPal than Nvidia. So if you enjoyed the video, give it a like, and bye.